What if the smartest money in the world is quietly making the exact same bet right now? And most retail investors haven't even noticed yet. Not in stocks, not in bonds, not in real estate. Two assets, gold and Bitcoin. And the institutions accumulating them aren't talking about it loudly. They never do. But the data is there if you know where to look. And what that data is telling us right now is one of the most important financial signals of 2026. Let's talk about what's actually happening. We're living through a moment that most people don't have the historical context to fully understand. Sovereign debt across the world's largest economies has reached levels that would have been considered catastrophic just 20 years ago. The United States is carrying over $35 trillion in national debt. Japan is running debt to GDP ratios that defy conventional economics. European nations are quietly struggling under the weight of entitlement obligations they cannot mathematically fulfill. And the solution that every single one of these governments keeps reaching for is the same one they've always used. Print more money, borrow more time, kick the can. Here's the problem. The can is running out of road. Currency instability is no longer a third world phenomenon. The dollar, the euro, the yen, all of them have lost significant purchasing power over the past 5 years. When the currency that denominates your savings quietly loses value every single year, you don't feel it all at once. It happens slowly, then suddenly. And the people who understand this dynamic best, the macro hedge funds, the central banks, the sovereign wealth funds, they are not waiting for suddenly. They're moving now. And where are they moving? Into gold and Bitcoin. Now let me give you the actual numbers because this isn't speculation. This is data. Gold ETF inflows in early 2026 have surged to levels not seen since the post-pandemic uncertainty of 2020. Central banks, specifically those in emerging markets, but increasingly in developed economies, have been net buyers of gold for several consecutive quarters. The World Gold Council has documented this accumulation trend in real time. Countries like China, India, Poland, and Turkey have been quietly adding to their reserves. Why? Because gold is the only reserve asset that carries no counterparty risk. It doesn't depend on any government's promise. It doesn't default. It doesn't get sanctioned. It just holds value across centuries. Smart money has always understood gold. That's nothing new. What is new is what's happening on the Bitcoin side of this equation. Bitcoin ETF inflows in the United States crossed historic thresholds in 2024 when the spot ETFs were approved. But what's happened since then is even more telling. Institutional wallets, identified through on-chain analytics platforms like Glassnode and CryptoQuant, have been steadily accumulating Bitcoin throughout periods of price volatility. Here's the key metric you need to understand. Long-term holder supply is near all-time highs. That means the coins being sold by panicking retail traders during every dip are being quietly absorbed by wallets that do not move. Wallets that belong to entities with a time horizon measured in years, not days. Michael Saylor's strategy, formerly MicroStrategy, now holds over 400,000 Bitcoin on its balance sheet. BlackRock's Bitcoin ETF has accumulated tens of billions in assets under management in record time. These are not retail investors chasing a trend. These are calculated, long-term institutional positions built on a specific thesis. That thesis is simple. Bitcoin is digital scarcity in a world drowning in artificial abundance of fiat currency. And here's the part that almost nobody's talking about yet. The wall between gold believers and Bitcoin believers is collapsing. For years, the financial world was divided. Gold bugs dismissed Bitcoin as magic internet money with no intrinsic value. Crypto purists dismissed gold as a boomer relic that couldn't be transferred, verified, or used in a digital economy. Both camps talk past each other endlessly. But something has shifted in the institutional mindset. The smartest macro investors, people like Paul Tudor Jones, Stanley Druckenmiller, Ray Dalio in his own way, have started treating both assets as legitimate answers to the same question. How do you protect wealth when the monetary system itself is under stress? The answer increasingly is both. Not one or the other. Both. Because they serve slightly different functions. Gold is the multi-thousand-year store of value with deep institutional trust, central bank legitimacy, and near zero correlation to tech sector volatility. Bitcoin is the 21 million cap, digitally native, borderless, censorship-resistant alternative that appeals to a younger demographic and solves real problems around portability and sovereignty. Together, they form what some macro analysts are now calling a dual safe haven allocation. And the data suggests that early 2026 may represent one of the last windows to position ahead of the broader retail recognition of this trend. Let's talk about why the timing matters so much right now. We are potentially entering a cycle where multiple macro pressures converge simultaneously. Elevated inflation expectations, a Federal Reserve caught between cutting rates to stimulate growth and holding rates to defend currency credibility. Geopolitical fragmentation that is pushing more nations toward non-dollar settlement mechanisms. A bond market that is struggling to attract buyers at yields that don't outpace inflation. Each of these pressures individually would be concerning. Together, they create the exact macro environment where hard assets historically outperform. Gold has already responded. It has set multiple all-time highs in recent months. But Bitcoin, despite its ETF-fueled institutional entry, still hasn't been fully repriced to reflect its role as a macro hedge in the way gold has. That gap between where Bitcoin is and where it should be, if institutions fully price in its scarcity and hedge value, is what a lot of smart money appears to be positioning around right now. And the on-chain data supports this. Exchange balances for Bitcoin are declining. That means coins are being moved off exchanges and into cold storage, into custody solutions, into long-term holding wallets. When coins leave exchanges, they're not available to be sold quickly. The liquid supply shrinks. And when demand eventually catches up, when retail finally recognizes what's happening, a shrinking liquid supply meets growing demand. You can do the math yourself. Here's the core takeaway from all of this. The old tribalism between gold and crypto is a luxury of bull market complacency. In a world of currency debasement and sovereign debt stress, smart money doesn't pick sides. It follows the logic. And the logic right now points to both hard assets as a critical allocation. Most retail investors are sitting in cash that loses value, bonds that barely keep up with real inflation, or equity portfolios fully exposed to whatever the next macro shock brings. The window to think differently, to actually look at where institutional money is flowing and position ahead of the mainstream, that window does not stay open forever. The data is there. The inflows are happening. The on-chain metrics are clear. The macro case is sound. The only question is whether you act on information early or you recognize it later when the price has already reflected it. If this opened your eyes to something you hadn't been paying attention to, share this with someone who needs to hear it. Drop a comment telling me whether you're in gold, Bitcoin, both, or still on the sidelines. I read every single one. And if you want to be the person who sees these macro shifts before they hit the headlines, subscribe now. This is exactly the kind of content we put out every week. Don't miss what's coming next.